Welcome to the Daily Brief, where I'll go over the action in the market for Thursday, March 23rd, and then we'll see how things look for Friday, March 24th. We had an up day, but it wasn't really a strong up day. Most of the gains were set right after the open, and then we spent the rest of the day drifting lower. Even though we closed up on the day, a lot of that strength was given back. So technically, our indicators are still looking more negative. Even though we have these positive backdrops behind us, we're just not seeing a real upthrust right now. And a lot of that has to do with the instability that's going on in the banking sector, worried about the Fed. Are they going to raise interest rates too much? Are we going to go into a recession? And when the market has all these things to worry about, they tend to sell rather than buy. So any kind of strength that they're seeing in the market, that can bring in a wave of selling. Now that can always change. We can shift back over to a positive stance. But for right now, we're just maintaining more of a negative stance. One little bit of information, the supplemental video that I usually upload on Monday, that's being merged into other videos that I do. And also from April 22nd through May 11th, I will be traveling. My intentions are to post videos if I'm able to do that. And if I can do any of the additional videos like the weekly video, intermarket analysis video, the deep dive video, I will do those as well. All right, let's go back and talk about what happened. We did have a gap higher open, and we were above the daily pivot at 39.71. We went all the way up to R1 at 4,006. That was positive, but then we spent the rest of the day giving a lot of that back. As the day went on, prices then retreated down to the daily pivot. We went below that. We went down to the unchanged level. We continued going lower down to the 200-day simple moving average at 39.33. That's about the place where we found some support. We rebounded slightly and then closed positive on the day. We were up 0.3% on above average volume, so that ticked up a little bit. The technicals, as I said, they're still shifting more negative. We need to see a good, strong close for things to really shift back and look better, because of the inflation and interest rate concerns that the markets are dealing with, and this whole banking thing that just seems to be going on and on and on, wondering if it's even going to get worse from here. Here's the intraday chart, how we really gapped up. From Wednesday's close, we went above the daily pivot, got all the way up to R1 before declining back below the daily pivot. We came all the way down to the unchanged level, even fell below that. And just about at the 200-day simple moving average, the market was able to find some support and then bounce up a little bit off of that going into the close. Here's the value and growth charts showing how they fared fairly well. Growth did do better in Thursday's session, where for large caps it was actually up 0.54%, where value was down. With the mid caps, it was down less than value, and the same thing is true with the small caps. So even though these last two areas were down, they were down less than the value. Here's the SPY showing the overnight session, where after drifting sideways, we did get some strength out of this, but then gave a lot of that back. We drifted sideways. Then when the overnight session ended, here's the spike up, and then we spent the rest of the day coming down. We actually went negative for a while and then bounced back up. And there's also some gyration going on in the overnight market session that we'll have to see how that feeds into Friday's session. What are some comments that we can make? The Bank of England raised their rates 25 basis points and hinted that they may do more of that in the future. The central banks in Switzerland, Norway, Hong Kong, and the Philippines also hiked their rates. The Swiss National Bank said that the country's bank crisis is over. Okay, we'll believe it when we see it. Bank stocks were again weak in Thursday's session. The dollar was up and interest rates were down, which usually gives some support to stocks, but it didn't do all that much as the day went on. The 30 to the 5 still remains normal, and we're watching our other yield curves because when they go back to being regular instead of being inverted, at that point where we start the countdown to see if we're going to go into a recession. Sentiment is still negative. It ticked down just a little bit to 37 where it had been at 38. Our trend is negative. The red line's still on top. It's weakening because we're below the moving average and we're below 20. I've kept our bias at mixed. Even though we had the up day, it wasn't a real strong up day. And overall, I've kept our momentum over the last 2, 3, 4, 5 days at negative as well. The economic reports that came out. Weekly jobless claims came in weaker than expected. And this is suggesting that the employment situation is still remaining quite strong. They came in at 191,000, where they had expected it to be at 204,000. And then we had the fourth quarter current account balance. It came in at minus 206.8 billion. Last time it was minus 219 billion. New home sales came in up 1.1% on a month-over-month basis. And if you seasonally adjust that rate, it's at 640,000 units. They expected 650, so a little bit weaker than expected. The last time we had this report, it came in at 633,000. And on a year-over-year basis, home sales were down 19%. Here's some Isabel Net charts. Goldman Sachs is saying, we forecast households will be net sellers of $750 billion in equities in 2023. This is just a forecast or an estimate right now. But they're not seeing very positive things going forward, and this could really feed into the downside pressure that the market is experiencing. Here's another chart that shows that cash allocation is on the rise again. It's not as high as it was before, and you notice that October 22, that so far was the low that we set. Well, it's starting to go back up again as we see a lot of nervousness in the market. This is looking at the forward earnings per share, where it has been declining overall. What we're looking at here is the overall trend that the earnings are going down when looking forward. This chart says that the U.S. True Financial Conditions Index is close to a 40-year low, so things are just not looking very good economically. This is another measurement of the lending standards, where it measures the net percent of banks that are easing their standards, and that's really dropping. So the opposite of that means that they're raising their lending standards or tightening them. And then you measure this with the Small Business Optimism Index. And these companies quite often have to do a lot of borrowing, so when they don't have access to capital, their optimism ends up going down. Another question asked, are you more likely to increase or decrease your bond portfolio? In yesterday's video, we talked about stocks. This deals with bonds. Over the next coming days or weeks, folks are still having more of a tendency to get into bonds. This chart just shows that we're still on the risky side of this zero line here. So folks are still experiencing a lot of fear in how they want to allocate their funds. And this shows all the different flows going into equities. This gold line here is cash, and that's starting to pick up. Folks still get into stocks more than they do in bonds. This dark purple line here is corporate investment grade bonds, and the lighter blue line are treasuries. Looking at our charts, here's the Ulcer Index, where it's still above this moving average, showing there's an increase in fear in the market. Here's the VIX, where it ticked up slightly. Even though we had an up day, we spent a lot of the day going down. So it's increased on the line chart as well as on the bar chart. And the VIX of the VIX is also picking up a little bit with its measure of volatility of the VIX. The equity put-call ratio, after giving us this spike, it's been coming back down. This could give some good support to stocks, but we're not seeing a lot of follow-through in price. Here's another fear gauge, how it ticked up recently, as there's a lot of uncertainty in the market right now. Here's another fear gauge, how it ticked up after Thursday's session. Looking at our trend, the red line's still on top, so we default to negative. The ADX is below 20 and declining and below the moving average, so we are in a trendless environment. The daily chart is showing how we're still dancing right around the 200-day simple moving average. We were able to close back up above that, so far this level of support is holding. We also have this downward sloping trend line, which if we really start to fall, we'll be watching that level. Then on the bottom, you can see where volume did pick up slightly to above average. Here's a 2-year look at that same chart where we have lots of support below us, but if we break through that, that could turn things a lot more negative. We also have resistance above where we're at right now. Can we break through some of that resistance if we really get set to go higher? Our rune ticked up just slightly after giving us an extreme negative reading, but it's still negative overall. Looking at our short-term stochastics, ticking up a little bit above the dash line, so that's slightly positive. We're rolling over a bit now with our intermediate-term stochastic, and we're still looking better with the long-term stochastic. The force index is still below zero, even though it ticked up a bit, so in the short term, this is still negative. When we're above the 20-period moving averages, that's considered positive. When we're below, that's negative, and we're just a little bit below. More on an intermediate term basis is the 50-period moving average, where we're still below both the exponential and simple moving averages. And the 100 period, which is a little longer term but still in the intermediate term time frame, we're also below both of the moving averages. Here's our moving average tree where we're long term, we're still staying positive. We're above the 200-day simple moving average, but we're dropping below the short and intermediate term moving averages. The swing trading oscillator turning more negative now. It's turning down and going below zero based on price as well as volume. So this is negative. We're still seeing a mixed bag with our oscillators. The slope is still going up. The TSI is still going up. The MACD has now crossed over positive on the daily chart. We're turning up with the PMO, but haven't quite crossed yet. Looking a little better with the PPO. And our longer term oscillators, they are turning up, but they haven't crossed positive yet. Parabolic SAR still has the dots underneath, so that is positive. Chaikin oscillator still above the zero line, so that's positive, but we are declining, so showing some weakness. The vortex has the red line on top, or the green line is declining, so that is negative. Ichimoku cloud, we're waiting to see. Can we go up and back into this green cloud and then eventually break above that? So far, this overhead resistance is too much for the market to handle currently. Here's the PMO showing how we haven't quite turned over positive yet. We're trying to cross when we look at it based on price, but they're right on top of each other, and we haven't quite turned over positive yet based on volume. Here's the PMO study showing the PMOs that are rising. It's pretty much flat in Thursday's session, declining a little bit with the number of buy signals, and we're still declining with the PMOs that are above zero. The BPI ticked down just a little bit, but is above 30 after giving us an extreme negative reading. So that's positive with a negative slant right now because it declined. The NYSE bullish percent index, which gives us a broader measure, ticked down just slightly in Thursday's session. The Chaikin money flow starting to turn a little more negative. This red line is rolling over and we're starting to drop below zero. The balance of power is also dropping below the dashed line, so that's turning more negative. TTM squeeze still trying to advance here. If we can get above this green dotted line, that could turn the bars blue, which would be more positive. The go, no-go system is still neutral, and we're just a little bit above the 200-day simple moving average. Looking at our short-term fib levels, if we do go higher, we still have overhead resistance at about the 4,004 level. If we continue to fall, we have some support at the 3905 or 3906 level. We fall a little bit below that, we run into this 3883 level. Our longer-term fib chart, we're still below this 38.2% retracement, so we're just floundering now in no man's land. Then our longer term fib chart, if we go up, we have resistance at 40.20. If we continue to fall, we have more support at 38.26. This is a potential positive backdrop where the S&P 500 bigger stocks are doing better than the equal weight index. The Elder Impulse system for the S&P has switched back to neutral. And the McClellan oscillator, after coming above zero, has now dropped down below zero, so that has turned more negative. Here's a broader measure of the McClellan oscillator. We never did get back up to zero and showing a decline. The summation index based on price and volume. Price is now rolling over, or we're going flat based on volume. And this top part of this chart is calculated one way, and the volume is calculated a different way. So this is a good measurement to use for confirmation or for a divergence. New highs, new lows. We saw new lows really expand in Thursday's session. The 5-period moving average is trying to turn back up, but it hasn't quite crossed over yet. And it's picking up Thursday's action, so turning it a little bit more negative, where we're pretty much sideways with our 10-day moving average. Advanced decline line, after getting above this moving average based on price, we've now dropped below that. Volume is still looking a bit weaker. Advanced decline ratio, below zero and declining with both our 19 and 39-day exponential moving averages. Accumulation distribution, this is still positive. We're above this moving average, and that's showing some improvement, but we are declining. Volume picked up a little bit in Thursday's session. So after Wednesday, we were below average, but still, when you go all the way back to that last Friday quadruple witching, volume has been dropping off. Looking at the financial sector, the ratio to the S&P 500 is now showing continued weakness. Here's the bank ETF, which lost another 2.5%. The regional banking ETF was down 1.95%, and the other regional banking ETF was down 2.78%. And then looking at the ratio between regional banking and the financial sector, also showing that banks are coming under increased pressure. And here's First Republic, just to keep an eye on it. It fell another 6% in Thursday's session to close at 12.53. The Dow is still below its 50 and 200-day moving averages, although we're still right about at this support level for the month. So far, support is holding up, but we want to get back above these moving averages. The diamonds with the Elder Impulse system have now switched back to neutral. The NASDAQ, after giving us a recent golden cross, is still hanging in there fairly well. We're above this pivot level, but we need to break through this R1 level to show renewed strength. NASDAQ 100 also recent golden cross and staying above this R1 level. The Qs have changed back over to positive with the update. The Qs were up 1.19%. And looking at our fib chart where we came right up to this 38.2% retracement, we're bumping into that a few times. What would be very positive is if we can get above this 12,868 level and then close above that for the NASDAQ 100. The small caps, recent golden cross, showing some weakness, and now we're starting to break below support. That's more evident on this chart where this support level had been holding up. Now we fell down below that. Although we did close above that support level in Thursday's session, the RSI is showing weakness, and the MACD continues to be in a downtrend. The small caps for the Elder Impulse system are still neutral, and the small cap ratio to the S&P is still showing a lot of weakness. The mid caps, recent golden cross, coming down below its 50 and 200-day moving averages and pretty much chopping sideways as of late. And the Elder Impulse system for the mid caps remains at neutral. Looking at the home builders, the interesting thing on this chart is we're seeing this relationship start to deteriorate. If it drops down below this dash line, that means they're going in opposite directions. If home builders are going down and the S&P is going down, that would be a negative divergence. If the home builders are going up but the S&P is going down, that could be a positive divergence. The copied curve is trying to give us a buy signal, and the Pring bottom fisher is very close to crossing over, which could also generate a buy signal. Looking at bonds, we're still dropping with yields as we're seeing this flight to safety from stocks into bonds. We're down just a bit over 3.4%. And here's the price of bonds, how they've really been spiking up, chopping sideways, but starting to break out a little bit. The RSI is above 50 and advancing, and the MACD on the bottom is still positive. Looking at the long-term trend, this is a weekly chart of the S&P. What we're trying to determine is this breakout that we saw above this downward sloping trend line. Is that a breakout or is that a fake out? We're still above this trend line, so that's positive. But looking down at the MACD, it's right on top of its moving average. If we break below this and this MACD turns down, that could suggest that the breakout ended up being a fake out. An update of our possible positive scenarios. This is still holding up quite well and could provide a good positive backdrop. The Qs are still outperforming the S&P. Not really seeing a lot of strength now in discretionary, but large cap growth is outperforming large cap value. Looking at our growth to value ratios, large caps doing well, mid caps doing well, and the small caps are doing well. Looking at the 50-period moving average of the highs minus the lows, we're dropping below zero, so that's negative. Then looking at the indicator itself, we're still below zero with this, and the longer we stay below zero, the more the red line that we look at on the previous chart will continue to decline. 2-year Treasury, after really spiking up, it's been coming down. Sometimes that gives support to stocks, but we're just not seeing that yet. And then our staples to S&P 500 ratio. This ratio is going back down a little bit, but we're working off of this spike, which could give some really good support to the S&P. What we want to watch for now is this spike that we see right here. If it really starts to go down, we could also work off of this spike. So what's our outlook for Friday? Technicals are still more negative. Even though we had the up day, there was a lot of weakness inside of the day's session. We have durable goods coming out on Friday, as well as the preliminary IHS market manufacturing, as well as services PMIs. Those are two separate reports, not real big influential reports in the market. And then the whole list of geopolitical events. Of course, you've got inflation and interest rates, but the markets are still fixated on what's happening in the banking sector. Looking at the Stock Traders Almanac statistics for March 24th, we tend to be negative overall. The Dow's only up 33.33% of the time. The S&P's up 42.9% of the time. The Nasdaq does a little better, and it's up 47.6% of the time. When we're at 50 or below, that is negative. And then the other things that could be adding a positive backdrop to the market, but we're just not seeing a lot of follow-through yet. We're on trading day number 18 now for the month of March, where we look at the dashed green line here, where it does have a tendency to decline. And then we're coming into that period of the month of March where we tend to show some more weakness. So our scenarios, can't really go with the down one because we're not trending, even though the technicals are turning back more negative. Can't go with the up one because our charts are pretty much negative right now. Even though we have these positive backdrops, we need to see follow through based on price. So now we're going with the sideways trend because the ADX is weakening. It's below 20. It's also below its moving average. And the red line is on top, so it is negative. Our conclusion, the S&P, it's turning back more negative, even with the up day. Short term, we're still negative. Intermediate term, we're showing more weakness. Long term, we're still positive because we're above the 200-day simple moving average, and we had a recent golden cross. Thank you. I do hope that you found this video helpful. I hope that you have a very good day, and I will talk to you in the next video.